We're here to talk about the Silicon Valley real estate market for the week ending August the 1st, presented Saturday morning, August the 2nd. These are the key chapters we're going over with the associated graphics. Let's get into the first summary data slide. This is the micro market areas. You can see in a nutshell, the Silicon Valley is cooler than it normally is, more favoring the buyer than it typically does. However, it is still fairly aggressive marketplace. I wouldn't say it favors the seller strongly. I would basically say it's a balanced marketplace, and we'll get into the details. This is the volume of sales based on the previous week. You can see that we are continuing to perform right around the blue line. The blue line is the least number of offers accepted that you would expect based on the previous 10 years. The median is the gray line, and the red line is the most you'd expect. We've been down here now for a full 3 years. And why there's the lack of activity is hard to explain. It's not a lack of inventory because we've had quicker pace marketplaces. It's just the buyers aren't out there and the sellers aren't out there to some degree because the market remains somewhat in balance. Here now is a summary of the key indicators. Inventory. Inventory is right about where you'd expect it to be. Yes, 5 weeks ago, we had a surplus of inventory. We had almost the most inventory we would expect. In 11, 12 weeks back, we go back up to a full quarter 13 weeks ago, we were actually above the most inventory you'd expect. But inventory has been coming down a little bit. The Mercury News did an article this past week, but they were talking about inventory back in the month of June. We're now in the month of August. Offers accepted right at the lowest level you'd expect, and I think it's just under the least number of offers you'd expect is 1959. We're actually at 1942. This number, the 1942, is the current number, will more than likely increase and then decrease as transactions fail. It will increase initially because of late reporting of offers, and then it will start to decrease as transactions fail. So we're below the least amount of offers you'd expect. We're sitting there at about 75% the transactions you'd expect, and that's what we've been. Closings, which is what I actually should be calling transactions because they are officially transactions once they're closed. They were at 80% a quarter ago. You're down to 70%. You can see that you've crossed over and you're below the least number of transactions closing that you'd expect. And the numbers are over here at almost 2,100, and you're only at 1,950. Days unsold inventory is the seller-buyer balance, the supply-demand balance, the turnover rate of the marketplace. You can see that we're slower. We're above the blue line, so we're slower than the slowest you'd expect. The slowest you'd expect is up here at 47 days, and we're at 51, almost 52 days. So you're 27% slower than you typically were. But a quarter ago, 13 weeks ago, we were 70% slower than you'd expect. Moving on to marketing time. This is how long it's taking 3 out of 4 sellers to sell their property. And this is continuing to climb. It's continuing to climb at a faster rate than the blue line. The blue line changes in a couple more weeks to a slightly steeper slope. What also happened this year is the marketing time started to increase earlier than they typically do. But we've gone from 21 days to sell 3 out of 4 homes to 36. So that's 5 weeks. So even though we might be talking about the market being a little slower than normal, it's still 3 out of 4 sellers are selling their home within 5 weeks. And by selling their home, that's an offer accepted. That's still pretty quick, but that's 60% longer than it normally is, up from 40% longer than it normally was. Price reductions. This is a measure of the seller's expectations when they're doing their homework to put the house on the marketplace. They do their research. They price their property most of the time at a price to sell. The market has changed, or if the market's decreasing, sellers tend to overestimate because they tend to look at comps and not current market conditions. And so as this number increases, and you can see we're actually improving, which is a decreasing number, because you're getting closer to the blue line, that means sellers are starting to realize, hey, the market isn't as great as it should be. We need to be a little more cognitive. We can't go out and ask for the top pricing any longer. But when we're looking at the magnitudes of this, typically you're only talking about 0.9% price reduction. Right now you're at 1.5% or 1 2/3% reduction. That's still a fairly small amount. The reason that is so small is, again, most of the sellers are doing their homework and pricing their home where it sells, and 3 out of 4 sellers are selling in 5 weeks, which doesn't really give a seller time to come on the market, find out they mispriced, and actually lower their price. Overbidding. 13 weeks ago, we were at 7.2%. The typical is 7.3, so we were basically right at the typical level based on the past 10 years. Now you're only at 3.4% overbidding. So overbidding has come down by almost half, or a little bit more than half actually. And typically overbidding is 6.3% above the seller's ask price. So you can see that the overbidding, the purple line, is below the blue line. So not only are we below where you'd expect to be, which is the gray line, you're below the least amount of overbidding you'd expect. So buyers aren't feeling the need to overbid as aggressively. And this is the magnitude of their overbidding, not the frequency. Now we're looking at three key indicators back over a long period of time. We're going all the way back to January 1st of 2015. That way you can see all the 10 years up through January 1st of 2025 that go into my 10-year median and my market 90 percentile and 10 percentile. So inventory, remember I mentioned earlier, the Mercury is doing an article about how inventory was climbing. Well, you can see that it reached its peak back here even before June, and they were talking about June inventory, and it's been declining ever since. So yes, when they wrote the article back here in June, we had more inventory than we normally do by 20%, but instead of continuing to increase, it had already been decreasing, and we're now below. We actually have a shortage of about 1 or 2% of the number of inventory that we typically have. Now, granted, that's been higher than it has been since the pandemic, which is 2020 right here, this big spike. So you can see since the pandemic, we've had a shortage of inventory except for earlier this year. But you have to be careful. We're already into August, and the article that came out this week was talking about inventory in the month of June. And yes, inventory was increasing in raw count until just about July 19th. And I think I mentioned that about 2 weeks ago, where inventory typically peaks out on July 19th, and it peaked out this year on July 19th. So anyway, inventory not only is coming down, it's now below where you'd expect it to be. And that's current information as of Friday, August the 1st. Now moving on to offers accepted. That's the orange line down here at the bottom. You can see that we're somewhere around 75%. You can see we've been around 75% ever since about midway through 2022. So that's basically 3 full years now of low level of transactions. We're missing out on about 25% of the volume of transactions. And then the speed of the marketplace, you can see just a little while ago, about 13 weeks ago, we were at record slow days of unsold inventory, the record low turnover, except for the pandemic. In fact, I expanded the graph back here because I wanted to see if this was going to continue to go up or turn down, because this graph used to cap at 170%. But instead of continuing to climb, it did a U-turn and it improved, which is a faster turning over marketplace. And you're just about 128%. So 28% slower than you typically are, which in Silicon Valley is still a fast-paced marketplace. Now we're looking at each component individually. From the left side of the green line, it's what I call the condensed scale, and that way I can get 9 years of data in. The 2024 is expanded, and so is 2025. 2024 is expanded so you can see the slopes and get some reference of what it should be doing in current lines. Same concept. The red line is the least amount of inventory you'd expect. The gray line is the typical amount of inventory you'd expect. And the blue line is the mostly inventory you'd expect. And the purple is the actual raw data. You can see that earlier this year, early in the second quarter, we were above the blue line, so more inventory than you'd expect. But then notice, right just before July the 1st, we had this huge correction where we went from basically the blue line down to the gray line in 1 week. And then we bounced back up for July the 4th, and then we came back down again. So for whatever reason, inventory was pretty volatile. It had been more than normal. It's now absolutely normal. Actually, it's a little bit less than normal, but close enough to call it normal. And here's on a percentage basis. So this is now looking at the past 10 years, comparing the same week to the same week to the same week for 10 years. And where do we stand now? So you're like 98% of the inventory that you'd expect to have for this particular week based on the past 10 years. I start my calendar year for real estate on March the 1st, move forward 7 days at a time until you get all the way around to February 21st. And then I jump forward either 8 or 9 days for leap year to get back to March 1st. So I'm always comparing the same dates. It's not always going to be the same days of the week, but there's always going to be at least 7 days of the week. Offers accepted, you can see you're right on top of the blue line, so you're having the least number of offers expected. And you can come over here and see the raw counts about 1,950, I would guess. You'd expect to be up here somewhere around 2,750 transactions. So we're missing about 600 transactions. Here's compared to normal, and you can see that basically pandemic hit, we had a huge surplus of transactions for about a year and a half. And then we hit to Valentine's Day, in my opinion, of 2022, and the market just corrected and went down and down and down. And then we got this new level that's around 75%. Yes, for 2023, it was probably closer to 70%, but 2024 and 2025 have both been closer to 75%. Here's the speed of the marketplace. This is the turnover rate. You can see that you're above the blue line. So you're clearly slower than you're supposed to be, because you're supposed to be down here on the gray line, which is somewhere around 34 days, 33 days. And you're up here at something like 51, 52 days. But still, to sell the entire inventory out in 52 days, less than 2 months, if there was no new inventory coming on the marketplace, which is the definition of the turnover rate, that would be huge. I mean, that's still a fast marketplace. We're just used to we basically are used to a superheated real estate marketplace in the Silicon Valley area. And instead of having a superheated, we just have a heated real estate marketplace. Here's your days unsold inventory. So you can see it was up to 170%, so 70% slower than normal. Right now, you're only at 28% slower than normal. Yes, you are slower than normal, but slower than normal for Silicon Valley is still fast paced. Here's your marketing time. This is an easier number to do, and here's where you can really see the shift. Normally, the slowest marketing time happens about midway through first quarter. This year, it happened the last week of 2024. Notice at the bottom, so that's basically 7 weeks earlier than normal, half a quarter. Now notice the bottom. Normally it doesn't start going up to halfway through second quarter. Here it went up halfway through first quarter. So it's a full quarter, a full 13 weeks earlier than it should be. And then it's just been climbing, and it's climbing now at a steeper rate than the blue line typically does. Now, you might point out that if the blue line shifted over, this would be shifted over, and we're on the steeper part of the blue line. So it's sort of behaving like you did. It's just behaving like it did a quarter sooner. And I've never seen in the 10.5 years that are up here, there's no other time shift of this magnitude. It's like the seasons have shifted by a whole quarter. I have no explanation for it, but it's clearly there. Where the market goes in the future is anybody's guess, but we're clearly taking longer than we normally do. But again, you're still taking only 36 days to sell 3 out of 4 sellers. Now, that is also only including the sellers that are successful in selling, and that may be part of the equation. Now, going back to typical, and again, here's where you're comparing the raw data to the 10-year median. You can see that the market was slowing down faster and faster, at a faster and faster rate, or a slower and slower rate, I guess is really what it's doing. And now it's turned around and it started to improve. So now you're only 60% slower than you typically are. Here's the 90th percentile seller that's taking the largest price reductions. How much are they taking as a price reduction? Basically, you're at 14.5%. That's pretty significant. So yes, there are 10% of the sellers out there that are taking a 14.5% or larger price reduction to get their property sold. This is the reduction in ask price for the sellers that are eventually successful in selling. Here it is compared to typical. You can see you're up here in the blue. You're basically 35% bigger price reductions than they typically are, because that 10 percentile is normally taking large price reductions. Now, to show I'm not just playing around with the numbers, here's the average. But the average is only 1.6%, which sounds like a very small number. But something like 78% of the sellers are doing no price reduction whatsoever. So you're adding in a whole bunch of zeros, which is how this number gets from 14.5% down to 1.6%. So on average, the sellers are doing very small price reductions, but the trend is the same. You can see that we were taking larger price reductions than typical, normalizing it. And now you're right at the most price reductions you'd expect. Here's looking on a percentage basis. You can see that you've improved a little bit. Here's where we were the worst. We were almost taking as large price reductions compared to normal as we were in the 2022, 2023 slowdown back here, and also right in 2019, which was after we had that weird double appreciation rate in Santa Clara County. Here now is the frequency of price reductions. So how common are price reductions? Only 22% of the sellers are doing price reductions. That means that 78% of the sellers aren't doing price reductions. And the number of sellers have actually leveled off the last couple of weeks. Remember, the vertical lines here are going to be quarters. So this is basically July 1st, and you can see you're basically flat. So here's typical price reductions compared to normal. You can see that you're 40% more price reductions than normal. That's an improvement from almost 80% more price reductions than normal. But again, the number of sellers that are doing price reductions is a fairly small number. Here's the magnitude of overbidding. This is the median overbidding. You can see we're down here at about we're about 0.5% overbidding on median. The average is up somewhere around 3%. You can see that you should be up here somewhere around 4%. You're right at the blue line, so you have the least amount of overbidding that you'd expect for this time of the year. You can see it's below. This is actually raw number, and this is the average. So here you can see that you're 3% less overbidding than normal. So for example, if the current overbidding is 2% above the seller's ask price and you're 3% below, the normal amount of overbidding is 5%. And those are rough numbers. It's probably closer to 6 and 3% overbidding right now. Here's the frequency of overbidding. More than 50%, 54.5% of the sellers are getting more than their asking price. So again, that's sort of where I'm trying to make this balance. Yes, the market is slower than it normally is for Silicon Valley, but you can't complain that we have a bad marketplace if more than half your sellers are getting more than their asking price. Here is the frequency of overbidding versus typical. So we're 80% of where you normally are. So you have 20% less of the sellers getting overbid. So rough numbers, it's at 50. So normally it's at 60. That 10% difference, because it's at 50 percentile, actually becomes 20%. Here's pricing, and now it's starting to be more apparent that the straight up pricing model is not as accurate as coming up at 12% for 7 years and then coming across it flat for the last 3.5 years. Yes, you were a little low in 2023, and both times in 2024 and 2025, you were a little high, but you're coming back down. No reason to expect that you're not going to change very much. And the more that we spend in this sort of balanced marketplace without prices going up, the more the two-step pricing model is going to become more and more apparent as being the correct pricing model. But either one you're going to use, 12% appreciation or 11.4%, that's pretty good. This flat isn't so good, but real estate is sort of complicated. You have the investment aspect and also the family emotional aspect. Real estate is good investment in the long term, and when you can buy and find a house that meets your family needs is the time to buy for you. Here now is we have 3 different distributions. The first one is days on marketplace. The purple line is the current line, much cooler than the dotted line, which is where we were a year ago, and we're starting off a year ago, and we're going to step through and look at the distribution. This gives you an example, though. Here's the median, the 50 percentile is the median. See how close together those numbers are? That's one of the reasons, primary reasons I shifted up here to the 75th percentile, is to get some separation so you can see as the market slows down. Roughly half the sellers come on the market and are selling their home in the same amount of time, regardless of the market conditions. So tracking the left-hand side of this graph at 50% or the median would make no difference in your data. And the average is not a very good indicator, because if a person sells after trying for 2 years, that's going to bring up your average. And again, that's why I picked the 75th percentile. If I was knowing what I know now, if I had that knowledge 15 years ago, I probably would have picked the 80 or 85th percentile. But anyway, let's start through. We're starting off on the dotted line down here. You can see jumping through 1 week at a time initially, and then you start jumping to 2 weeks at a time right there. So we're end of September, October. Now you're sort of just bouncing around, and now you're starting to slow down for the end of the year. Notice the climb, keep climbing. Right there's the peak on January the 10th. Keep in mind, I only have every other week, so the real peak is January 3rd. That's the bottom, the hottest. Now it's going to go down lower, but see how the top end got flatter? That's already improving marketplace, even though the line was lower. And that's why I did the steep right-hand side graph back here. Now you're coming up to present day fairly soon. You can see it's still climbing. One more week, and now we current data. So the only time that was slower was right at the end of the year. So we're taking longer times to market. Now doing the same thing with price reductions. The purple line is the current line. Notice for the most part, the purple line is the coolest because down here is your cool line. So that means the most price reductions. So currently right now, we're taking more price reductions, except for right through this part of the distribution, than we have in the past 52 weeks. We'll go through, we're stepping through. We basically don't have much movement during the summer months, which, you know, is not what people think. A lot of people think that the summer months is a great time to sell. In Silicon Valley, it actually happens earlier. Here comes the slowdown. There's the slowest month right there at the end of December. Look how rapidly it climbs up. That's the fastest, least amount of price reductions. Then you start cooling off. And basically from about there forward, end of May, you really don't have much price reductions. Yes, you drift down, but they're not large price reductions. So you basically have a very narrow window where the amount of price reductions is changing. And the third and last distribution is buyers overbidding. This shows how much pressure the buyers feel. Purple line is the current line down here, which again is the least of the last 52 weeks. And a year ago, you were up here. So clearly buyers are not feeling the need to overbid as much this year as they did last year. Stepping through, you can see there really isn't much movement from week to week to week. And this also requires sale price, so it's delayed by about 4 to 6 weeks. So instead of falling down to Thanksgiving, it falls down close to the end of the year. Right now, it's starting to go down. Right there is the bottom of the marketplace on February the 7th. It's rapidly accelerating. That's the peak of the marketplace right here on April the 5th. And then you're going to cool down a little bit. And then fairly soon, right about here, you're right there is probably the last major reduction. And now you're just sort of coasting along. But you're taking less overbids than you normally do. And again, here's the current line. So notice the purple line is the least amount of overbidding out of the past 52 weeks. Here now we're looking at the three counties, San Mateo County in the orange, Santa Clara County in the blue, and Alameda County in the gray. Right off the bat, it's noteworthy that San Mateo County is basically back at the normal level and actually set a record high, breaking over 600 listings for the first time in the last 10.5 years. Alameda County is very normal again as far as level of inventory. So only Santa Clara I got a lack of inventory. The blue line is below where the blue line historically was. Now, even though Santa Clara had less inventory, it's selling the same number of homes as Alameda County. So Santa Clara County clearly has a faster turnover rate than Alameda County. And you can't compare San Mateo County because it had record high or close to record high inventory, and volume of transactions or offers is clearly down. And here is the comparison. So Santa Clara County has the fastest days on unsold inventory at about 47 days. San Mateo County is next at about 49.5 days. And Alameda County is the slowest at 58 days. Keep in mind, to sell your entire inventory out in less than 2 months is still a fast-paced marketplace, even if it's slower than we're used to here in Silicon Valley. Here's the marketing time. Alameda County's got the longest marketing time. This is that 3 out of 4 benchmark, 38 days. And then Santa Clara County and San Mateo County are tied at 35 days. So 75% of your sellers are selling in just over a month, 5 weeks. 5 weeks. Here's the magnitude of list price reductions. You can see that Alameda County is taking the most, and this is average, but that's only about 1.75%. San Mateo County is next, and the least amount of price reductions is Santa Clara County at 1.5%. So 1.5% average price reduction is pretty small and pretty reasonable. Frequency of price reductions. Here you can see the most price reductions in Alameda County at 24%. That's less than 1 in 4 sellers are doing a price reduction. In Santa Clara and San Mateo County, it's closer to 21%, which is essentially 1 in 5 sellers are doing a price reduction. So these price reductions are not widespread. This is overbidding, magnitude of overbidding. What's interesting here is even though Alameda County was the slowest and had the most price reductions, it has the most overbidding at 4.5%. What's happening is listing sellers are coming on the market, testing the market, reducing their price. They overstep where the buyers were willing to buy. The buyers then come in and overbid the seller's reduced price. And that's how your area with the most price reductions and longest marketing time can have the most overbidding. Santa Clara County and San Mateo County are very close together. Santa Clara at 3% overbid and San Mateo at 2.5% overbidding. Here's the frequency of overbidding, very close together. All of them about 54, 56% of the sellers are getting more than their asking price. So more than half the sellers are getting above their ask price. Now, granted, that's down from the 75% and coming down at a pretty steep drop. The only time where I'm seeing that it's dropped is back here. But you also have to keep in mind that the x-axis has half as condensed. So this line here compared to the slope of the line here is really should be half the steepness back here. So it's even hard to visually climb. But I'm pretty confident this is a slower slope. This was pretty dramatic back here in 2022. Here's the long-term appreciation. Santa Clara County is doing the best at almost 100% appreciation. San Mateo County and Alameda County are right together at about 64. Oh, actually, that's almost 70%. 70% appreciation for San Mateo County and 66% appreciation for Santa Clara, for Alameda County. And that's since the last 9 months of 2015. I tried to find a whole year with flat pricing. I just couldn't do it. Here now is the price on log paper. You can see San Mateo County is the highest at about 1950, 1,950,000. Santa Clara County is second at 1,900,000. And the most affordable is Alameda County at about $1,250,000 for the medium priced home. Here's the same exact information on regular paper. The first was on log paper. And here's estimated payments using an 80% loan and using the federal national average for high balance conforming loans. So in California, with most people doing jumbo loans, your interest rate would be lower, your payments would be lower, but I can't find a long-term history for jumbo money. I'd really like to do it. If anybody knows a website that goes back 15, 20 years of jumbo money interest rates in Santa Clara County, I would love to update my data. Here is active inventory. These are micro markets. I divide Silicon Valley, the 3 counties, up into 20 micro markets and compare. Right off the bat, Silicon Valley is 2% more inventory than expected. That's essentially normal. Santa Clara County at 99.3%. The only area that has a surplus of inventory is San Mateo County at 31% more inventory. And Alameda County actually has a shortage of 4%. And it's got 95.7%. For Alameda County, for the first couple slides, I only have countywide data. The others I have the micro market data. So you can see in Santa Clara County, the ranges from the highest inventory in East San Jose, South San Jose, and Central San Jose at 16% more inventory than you expect, to the least amount of inventory in Saratoga Los Gatos at only 70%. So within Santa Clara County, there's almost a 50% range of simply looking at inventory compared to normal. When you're talking about those kinds of differences, you can't talk about one number representing the whole county. San Mateo County is not as dramatic. It goes from 2% to 133%, so that's a 31% delta. Here's looking at offers accepted. Notice how blue it is. This comparing to the 10-year median, because just looking at raw count of offers wouldn't help you. But you can see that Silicon Valley is at basically 75%, and so is Santa Clara. San Mateo County is actually doing pretty well at 90%, and Alameda County is at 73%. So San Mateo County is having the most offers accepted compared to normal. Here's looking at days of unsold inventory compared to the same. So this is the turnover rate of the marketplace. Well, Silicon Valley, first off, is at 32% slower than it normally is. Santa Clara County, 33%. San Mateo at 43% slower. So even though it had more active offers going through, it had higher level of inventory, giving it a slower marketplace. It's actually the slowest county compared to its own normal. And then Alameda County at 27%. Here's what the raw numbers are. So even though this previous slide was mostly blue, saying that the market's cooler than normal, favoring the buyer more than it normally does. This shows you the raw counts, and this actually is showing you the market's fairly fast. So yes, the market is slower than it normally is, but the market's still moving. Here's the same concept. Here's the marketing time, the 3 out of 4 sellers compared to the normal marketing time. So you're taking 3 times longer in Santa Clara County to sell the house than you normally do. That sounds huge. That sounds like you'd be crying you're not getting any sales. San Mateo County is almost 3 times, and Alameda County is even close to almost 3 times. So you're basically 1/3 the speed. You come over here, and what's that speed? The slow speed is selling in Santa Clara County in 35 days, 5 weeks. San Mateo County, same 5 weeks. Come down to Alameda County. Hey, guess what? The same 5 weeks. So to sell 3 out of 4 sellers in 5 weeks is still a fast marketplace. And I don't know how more I can stress that. Now you look at price reductions. Price reductions are greater than they typically are. You're somewhere around 2.5% of the sale price in Santa Clara County coming off. In San Mateo County, it's 1.5%. In Alameda County, it's 5% price reductions. That's huge. That's why everybody's blue. But now you go and compare what the actual magnitude is. 1.5% for Santa Clara County, 1.7% for both San Mateo and Alameda County. So those are fairly small numbers. So yes, they're bigger than they normally are, but they're still relatively small. Frequency of price reductions. Here you're a little bit more balanced. Santa Clara County, Silicon Valley is at 35% more price reductions than normal. But if you come down to Santa Clara County is at 7%. You go all the way from Cupertino at 93%, so less price reductions than normal, 7% less than normal, all the way up to Milpitas at 27%. So this is the frequency of price reductions. You can see that, right now, 22% for Silicon Valley, 21% for Santa Clara County, 21% for San Mateo County, 24% for Alameda County. So there's Alameda County doing more price reductions, but then you still have a hotspot. Fremont, you only have 12% of the sellers doing a price reduction. And then you go up to Oakland at 30%, or Pleasanton at 26%, or Dublin, Castro Valley at 31%. So that's the whole concept between these micro market areas. Even though there's a tendency to say that everything market moves the same, this widely varying data shows you that each market is its own market, and the market is not regional like Silicon Valley. It's not countywide. It's really these micro market data. Here's your overbidding from the buyer. So how's it compared to normal? So your overbidding is basically a percent. Well, Santa Clara County 2% below where it normally is. San Mateo 3%, and Alameda County 3%. So way blue looking here. But now let's look at what the numbers are. Here it becomes pink. How do you explain that? Because if you're getting 7% more than the ask price, that is not a bad marketplace. So again, the price overbidding is less aggressive than it normally is, but it's still aggressive. In Silicon Valley, you're at 3.5% overbid overall. San Mateo is the least at 2.5%, and the most overbidding is in Alameda County at 4.5% overbidding. So if 50% of the sellers are getting more than their asking price, and on average they're getting 4.5% more than their asking price, that's not a bad marketplace. Here's the frequency. Much more frequent price reductions than normal. So you're having less overbidding than normal. It's 80% in San Mateo County, 81% in Santa Clara County, and 75% in Alameda County. So the commonality, how common is overbidding? It's only 80%. You're missing 20% of the overbidding that you normally have on a frequency basis. But those numbers are still 55 to 74% in Santa Clara County. They're 40%, 34%, well, actually, 34% to 69% in San Mateo County, and 24% to 80% in Alameda County. That's still a lot of overbidding. Here's the appreciation. I'm pointing out that in Santa Clara County, you have had 98% appreciation, but when you look at that, not a single area has 98% appreciation. How do I explain that? This again shows the power and the importance of micromarket area. If the affordable areas like East Central and South San Jose sold less homes, and areas like Campbell, Cupertino, Saratoga, and Los Altos sold more homes than they typically do, that would raise the county-wide median price without raising the price within each area. So this again shows the importance of micro-market data because you clearly have had that shift. And you can see that San Mateo County is at 70% and Alameda County is at 66%. But again, you go all the way from a low of 26% in Foster City for San Mateo County up to a high of 73% in Redwood City. And those are right across the freeway from each other. Here on the median price in the middle, I also sandwich it by showing the cheapest 10 percentile on the left and the most expensive 90 percentile on the right. So you have a price range in each area instead of just one number. And again, that's broken down by micro market areas. Here's a summary. So again, year over year, comparing the past 10 years, we're much slower than we normally are, favoring the buyer more than we normally do. Then you come over here and look at the actual conditions. You're sort of a balanced marketplace. On the overbidding, you're sort of favoring the seller, but that's a lagging indicator. On price adjustments, which you know without a lag is sort of favoring the buyer. So that would tend to say the market maybe is shifting a little bit in favor of the buyer. And this is left over from earlier in the year because you have that 4 to 6 week lag time. And then appreciation and pricing isn't associated with market condition, favoring one or the other. It's just which areas have the most appreciation or red and what is the highest prices in red. Here's the number of offers. We're having the 9th worst year out of the last 10. We have the 24th worst year out of the last 25. What are we looking at? The worst year we had was 2023 at 1,700. We're at 1,900. So we're not going to get below 1,700. Again, the week before was 1,800 and we're at we are almost at 2,000. You're not going to fall below. But now here, 3 weeks back, you're at 1,999, and all we have to do is get down to 1,993. We'll get down there. So we'll have 3 weeks now in a row where we have the second worst year out of the last 25. Here's the raw numbers for Silicon Valley, Santa Clara, San Mateo, and Alameda counties. You can pick the metric that's most interesting for you. I boxed the 3 different days on market. So you have median, average, and 75th percentile. I like and use the 75th percentile the most. And with that, we've been talking about Silicon Valley real estate marketplace. We will be talking about the Greater Bay Area, 13 counties, 5 regions. I'm Richard Calhoun, Creekside Realty, real estate broker representing buyers or sellers. Appreciate likes and subscriptions if you haven't already done so. The blue up here is the YouTube link to the archives of these past presentations, or you can type in the shorter green root URL. To get the live presentation Saturday morning at 9 o'clock, you type in the green root URL plus the year 2025. If you want the handout, which I try to post every week about 8:45, and it is up right now, you can type in the green root URL H 2025-08-02, and the handout's out there. That's if you want to get the data before or don't want to listen to me ramble on my videos. And you can also get to any specific past episode by typing in the green root URL, the year, month, date code. These are the 5 regions that make up the Greater Bay Area. Here's an active inventory. You can see that active inventory is going down in the significant areas, those being the North Bay, Central Valley, Silicon Valley, and the cities. It's basically flat on the Central Coast. Here's the offers accepted. A huge increase in the North Bay and Central Valley as far as the number of offers accepted. A smaller increase in the Central Coast. Silicon Valley is clearly going down as well as the cities. So 2 of the areas most associated with Silicon Valley are going down. The other 3 regions are still having increasing number of offers accepted, with the most notable being the North Bay area. That's a very sharp increase in the number of offers accepted. This is looking at the turnover rate of the marketplace, the supply-demand ratio. It's going down in all 5 regions, which is an improving marketplace. It's turning over more and more rapidly as the number of days to turn over once decreases. The one that's flattest is Silicon Valley. The others the 4 are clearly down notably. This is looking at marketing time. Marketing time has been climbing in all 5 regions, but notice you have a flat in Silicon Valley, a step function here in Central Coast, which would tend to indicate going flat, and a step function in the North Bay indicating it's about to go flat. But then you still have the cities, which has a huge increase, and the Central Valley has a fairly large increase. So marketing times is increasing to flat, depending on which global region you're looking at. Here's the sell price reductions. they're all going down in the negative direction, which is bigger and bigger price reductions. They're still fairly small, but on average, they're 2.6% for a lot of the areas. The area that's doing the least amount of price reductions is Silicon Valley at 1.6%. This is the frequency of the seller's price reductions in order to get the offer in the door before the offer comes in the door. You're anywhere from 22% all the way up to 42%, depending on the region. They're all increasing. So that means more and more sellers are taking price reductions. Note that Silicon Valley has actually gone flat in the last probably 2 weeks. Magnitude of overbidding. This is the pressure the buyers feel when they're making the offer. They're all going down. 3 of the regions are now below 100%, which means on average, the sellers are getting less than their asking price. Granted, it's only about 0.2%, about 1% for the Central Valley, and about 1.5% for the Central Coast. Silicon Valley is still at 3.5% above the seller's ask price, down from 9% or 8.5%. And the cities is at 6%, or almost 6%, down from a number of 9.5%. So the amount of overbidding the buyers are sensing they need to make is clearly on the downward trend. This is the frequency of overbidding, also on the downward trend in all 5 regions, anywhere from a low of 30% of the buyers overbidding all the way up to 54% in Silicon Valley. But they're all, again, in the decreasing direction, which means less and less buyers are overbidding each week. Here's the long-term appreciation. Cities, San Francisco and Marin, are clearly doing the least well at about 40%. Silicon Valley is no longer the top dog, but instead that's the Central Coast and the Central Valley have the highest rate of appreciation, and then the North Bay is in between 70%. So you're going anywhere from 40% appreciation all the way up to 100% appreciation, and that's since the last 9 months of 2015. Here's long-term pricing. Central Valley is the most affordable at just about $550,000, followed by the North Bay at about $800,000. Then you have the Central Coast at about $1.25 million, $1,250,000. Then you have the Silicon Valley at about $1,625,000, and then the cities at about $1,650,000. So clearly prices are not going anywhere very quickly. You can see how long the prices have been flat. They basically hit the current level sometime in 2022 for the most part. San Francisco and Marin was significantly higher. That could have just been a fluke because those are 2 smaller regions, but San Francisco does have a fair amount of transactions. Here's the monthly payments in the same order using the national rate for high balance conforming loan limits. So in the Bay Area, with jumbo money being widely used and lower interest rates, these payments are an overstatement, but I have not been able to find a good source for jumbo money interest rates for ideally Silicon Valley or California. Here's all 13 counties, 5 regions. I've also added in the Bay Area. I do the Bay Area. I actually firmly believe it's a garbage number, that there's too much variations. There's too much variations in each county, but I include it because the media talks about the Bay Area real estate market quite a bit. So it's in there for completeness. You have the raw count under the now column. 1 week ago was the percent change from 1 week ago, and then the percent change from 5 weeks ago. So you can look at each one of the metrics in each one of the counties that you're interested in. And with that, we're back to the summary chart. These are the tables. The chapters you can jump to in the YouTube description. There's timestamps. You can jump to the section you find most interesting. I'm not seeing any questions. Thanks for joining. Take care. Have a nice week. Bye for now.